Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Joe Cavatoni, Head of Americas at the World Gold Council. We're talking about gold and gold ETFs today, and Joe is joining us via Skype from New York. Joe, welcome and thanks for joining us. And how are you doing?
Hi, Neena. Thanks for having me. And all things considered, I'm doing great.
That's great. That's good to know. So let's talk about gold now. Gold is up more than 12% this year, and it is currently trading at its highest level in almost 8 years. And to put that in perspective, the S&P 500 is down more than 15% this year. So it seems investors are piling into gold. So I wanted to get your thoughts on the gold's rally. Is it mainly due to coronavirus-related worries or record low interest rates or oil's, historic collapse, or is it because of massive monetary and fiscal stimulus being launched all over the world? What factors are driving gold's rally this year?
I think it's a great question, and I think everything that you laid out as part of that question are all factors that are weighing in to what's happening with the gold market and why the price performance is what we're seeing this year. Clearly, starting with COVID-19 and the coronavirus, a real tragic set of circumstances and a real global pandemic that's causing not only impact personally and across economies worldwide, but ultimately a factor that has amplified investors' requirements and needs and interests in making sure they understand the best way to manage a portfolio and have safe haven assets become a part of that. Switching a bit more to what we had been outlining not only in our annual outlook for 2020, but previously in 2019 as well, major factors that were already pointing to the fact that gold is likely to be an asset to perform well in the current market conditions. So absent coronavirus and COVID-19, what you'll find is that market risk and uncertainty, which is one of the most important strategic factors to consider when you look at the performance of gold, was very pronounced. Monetary policy, as you've highlighted, and the direction of currencies and central banking activity, interest rates, etc. Those were also factors leading to gold and the performance of gold likely to be such that it would be a price improvement or a price increase over time. So many factors at play leading into the obvious, very major impact that we've had with the pandemic that's hit the markets right now. So on a relative basis, gold has done extremely well as an asset. And what we're finding is as we go around the globe, it's not only one market where you're seeing investors looking at gold as a safe haven. You're seeing it more on a global scale. So you're seeing growth in ETFs in Europe. You're seeing growth in ETFs in the US. We're seeing growth in ETFs even in Asia, where the instruments are newer to the market. But in addition to that, the level of interest in gold across all assets or all mechanisms for accessing the market continuing to show signs of interest and consumption on the part of people. Now, where on the strategic side we've seen likely a less pronounced level of growth or even a decline in growth will be when it comes to the consumer side or jewelry side of demand, which is the other major factor that plays into why gold performs well on the long term, the strategic factor being economic expansion. There, clearly with India and China and consumer behaviors impacted by the recent activities and the recent market phenomena, you're going to find that those levels of consumption in jewelry in particular are going to be down.
Those are very interesting points. And I wanted to talk about the impact of coronavirus-related shutdowns at gold refineries, because I had read an article in the Wall Street Journal recently that there are severe shortages of precious metals stemming from shutdowns at these refineries. And that, coupled with heavy retail buying, has also pushed the prices of gold up. What what have you seen regarding shortage of physical metal?
Well, there's a couple of key facts that I think we should make sure we're careful to clarify. So gold was not alone in terms of what was happening with coronavirus, COVID-19, as it relates to supply chain. All industries worldwide have been impacted by that, and the gold market hasn't been impacted or exempted from that. It was also impacted. So clearly, transportation, the need to implement BCP or business continuity plans across a myriad of different businesses, refiners, for example, or other aspects of the supply chain. All of those factors played into certain impact to the gold supply chain. What I would say is that there have been refiners that have been shut for a temporary period of time. Those have been reopened. For example, there were a few that were cited in Switzerland that were closed at the time when we started to see an increase in overall consumption around the futures contract in the U.S. for COMEX. But these facilities are coming back online. They're actually producing gold. It's getting its way into the markets. And I think what we would probably characterize the situation to be more so a logistics issue and a challenge as opposed to a lack of gold in the system. There is a lot of gold in the system. It's getting it to the right places at the right times to satisfy the needs of the instruments that require it. And I think that was what actually has played out over the last couple of weeks, in particular as we look at the futures contracts on CME. The fact that there's a need for gold to potentially be delivered into a contract to the exchange for a physical mechanism was requiring gold to be in New York. And that logistical challenge of getting it from wherever it may be into New York was something that was brought to light to the industry. Again, gold is not the only industry impacted by logistical challenges. Many have been. But that's been what we've been hearing and seeing. Now, that doesn't talk to the OTC market, which is in London. And that market has a large stock of gold, and that market has not been impacted, as far as we can see, from the logistical challenges that go on in the system. So when you think about large bar markets, you're thinking about the OTC market in London, and that market is functioning with large volumes and plenty of capacity to handle the trading volumes of the interest on the part of investors.
That's
So I'd say that, I just to reiterate, I think it's important to understand that, gold's not alone in having potential. The gold market or precious metals markets, for that matter, have not been alone when it comes to logistical challenges, but by no means a standout and the only issue.
So let's talk a little bit about inflows into gold ETFs. And you mentioned that a little bit earlier. In fact, April is the best month of inflows in many years for some of the popular gold ETFs. So why do you think investors' appetite for gold ETF has been soaring of late? And give us a sense of inflows into gold ETFs too, because I know the World Gold Council tracks those inflows.
So you're absolutely correct that the gold market for exchange traded funds has seen record flows. And actually, simply put, the exchange traded fund is an easy mechanism for investors to get comfortable with, and one that has become well adopted and accepted, not only in the U.S. market, and if you go back historically, you'll find that the U.S. was the largest market for ETF holdings, but now on a global scale. So you'll see that within Europe, there are very large products that are very successfully distributed and consumed by investors across the different markets, whether that's in the UK, Germany, or Switzerland. So the mechanism for owning gold through an ETF is an understood market and a market where there's comfort and confidence that the product has physical gold behind it and its performance is tracking the precious metal. So from that perspective, people are quite comfortable that the products are doing what they're meant to be doing, which is to give you the price performance of gold for a reasonable fee to provide that manager the remuneration to run that for you. So if we look across the board, you'll see that the AUMs of really, kind of as of year to date, we're talking about 880 billion of total holdings in dollar terms. And you're seeing about $80 billion of that in Europe, $90 billion of that in the US, and the residual 7 to 8 spread throughout Asia and other markets, maybe South Africa. So you're seeing a balance of consumption. You're seeing an instrument that's available to be consumed not only by institutions, but by platforms and retail investors and many people who have access to financial markets and financial instruments that are being consumed to wrap other exposures. So that's why I think the ETF is a popular instrument, and it's an instrument that will continue to see inflows if the market continues to flock into gold, simply because it's really performing in line with what people are expecting.
I agree with you. ETFs are a great vehicle for most investors to invest in gold. And in my view, the best investment case for gold is that it usually moves inversely to stocks. So it is a great diversifier in a portfolio. But this year it has been very interesting. On some of the days we have seen that gold has fallen with other risk assets, mainly stocks, and that happened particularly on days when stock markets fell rapidly, and some of investors and traders had to sell liquid assets like gold to raise some cash. But do you think gold can still be a safe haven asset for investors?
We do. And actually, the point you're raising is one of the characteristics we often talk to clients about when we speak about the gold market and gold as an investment. So we highlight 4 characteristics: that gold provides returns, being characteristic number 1. Gold has a large and liquid pool that you can access, which is characteristic number 2. Gold has a positive impact on your portfolio performance, which is characteristic number 3. And the 4th is the diversification benefits that come with it. Now, I've given it in an order to take me to diversification for the conversation. We usually give it in a different order, but those 4 factors are what we highlight, and diversification is what you're specifically making reference to. And what statistically we can show through our website at goldhub.org, or with our data, which we're available to provide to people, and what we have to offer are the correlation behaviors of gold when the markets are declining and the markets are rising. And what you're going to find is that gold, when markets are down and when markets are performing poorly, you're going to find that it is negatively correlated. So meaning if the markets are declining, on average, gold will be performing in an opposite direction to that. And what we find when gold is performing, when assets like equities are performing positively, gold is positively correlated to that. So to many people's surprise, gold has a dual nature. It performs well in the down markets, but it also tracks well with the well-performing markets. Now, again, that is on average. That doesn't mean that every instance of an up market or a down market will always see that sampling be in line with that behavior. And what you're highlighting are moments like we've seen in the past. We have moments when large, fast-moving markets are coming off. It's dragging down all assets, including gold. But on average, you're going to find that the gold performance will be positively correlated to an uprising market, negatively correlated to a declining market. And in instances where large pools of money are exiting assets of all kind, it can get impacted by that behavior. So it does become a liquidity vehicle. People do use it to get cash out of their investments. And ultimately, price movements can show a similar trajectory for a short period of time, but it tends to go back to what I've talked about, the correlation and diversification benefits being appropriately correlated. So when I talk about the dual nature of gold, let me just clarify a little bit more on that, because earlier on in our conversation, I talked about market risk and uncertainty and a little bit of less interest or less likelihood that economic factors are going to, or economic expansion is going to play out. That's the dual nature. When markets are performing well and wealth creation is happening and economic expansion is playing out, you're going to see consumer behavior, jewelry consumption, etc. That will take over what's driving the positive behavior of gold. And when markets are not doing well and there's risk and uncertainty, the investment side of the equation takes over. So that's helping to get this dual nature, which is a unique feature for gold against other commodities. And that's why it does well, both in negative markets as a safe haven and in positive performing markets, which we're hoping we get back to.
Yes, very interesting points. So let's talk about the outlook for gold after this massive rally. It's up more than 12%, as we discussed earlier. And I recently saw a report by Bank of America. They raised their 18-month gold price target to $3,000 an ounce, which is up more than 50% from the current price. And the report was actually titled The Fed Can't Print Gold. And the investment case was that policymakers across the world, they're unleashing vast amounts of fiscal and monetary stimulus to help their economies which are hurt by the coronavirus, and that would boost gold prices. What are your thoughts on gold's outlook for the rest of this year?
So I also have had an opportunity to see the report, read it, and I think it's a really well put together piece, and I'd encourage your listeners to take the time to read the report. Very interesting insight from Bank of America. We tend not to want to put a price prediction or look to call the price of gold. We spend our time and our education making sure people are comfortable understanding how to analyze gold and have that information at their disposal to make the right decision as it becomes a component of their portfolio. So the way I'd look to give you insight and information on the gold outlook from here out through the end of the year and longer term is I would simply say two things. The first I'd say is the ownership of gold in a portfolio should always be viewed as a strategic asset, simply because of the benefits you gain from having the right kind of diversification and the right kind of contribution to your return profile and that liquidity that gold offers you. The second thing I'd say is you're going to have economic and capital markets assumptions. And I would encourage clients to take those assumptions down to our website, goldhub.org. I'd ask them to use our tool, because our tool that we've developed, known as Quorum, which is our valuation framework, will help people get what they're thinking about in terms of capital markets assumptions using our tool, which is very simple to use, and give them the opportunity to see what expectations are for returns over long term when they use those same capital markets assumptions they're using for other assets. So it's designed to help people get a picture and an outlook for what could be playing out with the gold price over the long term based on what those assumptions are you have in your portfolio. As it relates to our outlook, we have not deviated from where we were 2019 and into 2020, which are ignoring the obvious implications of COVID-19 and coronavirus, but really thinking about market risk and uncertainty, monetary policy, and for that matter, structural reform were the three things we've highlighted in our outlook. We still feel like those are fundamentally really critical issues for people to understand. So you're hearing that in the report that you see from Bank of America, and our view is ultimately that those factors still will be applicable even after we come through this current condition we're in with lockdown and economic impact from coronavirus.
Okay, so the World Gold Council has partnered with State Street on 3 gold ETFs, and that includes the most popular gold ETF, ticker symbol GLD. And I'm sure you must have heard some conspiracy theorists talking that GLD actually is just a fraud, it owns no gold. What would you tell them?
I think it's just what you've called it. It's a conspiracy theory, and it's incorrect. The mainstream gold-backed ETFs, as defined by their prospectuses and as they operate in the London bullion market, require gold to be in allocated accounts. And that's a fact. And ultimately, people should understand that that's written into the prospectus, and providers of all different competitive level will make sure that their operating procedures and their processes are in place to ensure that the gold's in the vaults. So when people say it's not there, it's incorrect. I personally have been to the vaults to visit and actually be witness to the counts that go on an annual basis and a semi-annual basis, meaning the bars are counted and verified and weighed and so forth. And this is just a conspiracy theory, and I think it just is usually perpetrated by people who have an ulterior motive, and ultimately are trying to create some sort of question around the products, when in reality, I think the volumes, the consumption level, and the overall outstanding AUM, and the fact that there are reputable firms that are running these products, stand behind them, and use mainstream institutions in the OTC market in London to help them facilitate this activity, should be something that investors should be quite comfortable with. It's a conspiracy theory, and it needs to just be understood that it's just simply that.
Yeah, thanks for clarifying that. So last year, State Street launched another gold ETF. It's the Spider Gold MiniShares Trust with the ticker
Yes.
symbol GLDM. Now, GLD is the most popular gold ETF. As I mentioned earlier, it has over 56 billion in assets. And in fact, GLDM has also been quite successful in raising assets. And it is one of the cheapest gold ETFs. It charges just 18 basis points. So for investors who are looking to choose the right gold ETF for their portfolio, what would you suggest? How do they compare GLD versus GLDM?
So State Street has been working with us, and we have both been very successful in making sure that GLD is satisfying the needs of many investor types. And in response to a need to ensure that they could get to all different types of investors, together with us, we launched GLDM, which, like you've said, is a low management fee product that is being designed and put out with GLD, like with their other low-cost products, to satisfy the needs of investors who are looking for the instrument that has a lower management fee, but performs similarly in terms of the exposure that it gains. So when you see the two products together, you understand that GLD, which is the first gold product in the US from 2004, a very robust capital markets instrument. It's large in terms of its AUM. Its daily trading volumes are very large, and there is an ecosystem of options, the ability to finance the instrument, lend the instrument, very much the kind of same structure you would see and feel when it comes to their S&P product, the SPY product. Very liquid, very established product, and very satisfactory for many investors. On the other end, you have a desire for some people who are less concerned about certain aspects of the capital markets and more concerned around buying and holding and having a product that's suitable for their needs at a lower share price. And that's what GLDM achieves for the clients that State Street is working with. They're able to offer choice while performing exceptional in terms of the products that they offer. GLD and GLDM, both giving you exposure to the gold market, functioning well. And in response to those needs, State Street have worked with us to bring a product to satisfy everyone's requirements.
That's very helpful. And I should add that in full disclosure, I own GLDM in an ETF investor portfolio
Excellent.
that I manage for our clients. Now, you mentioned about ownership of gold and the role of gold in a portfolio. And I get questions from our clients sometimes that how much gold should be there in a portfolio. And I usually recommend 5 to 7% in a diversified portfolio. What are your thoughts on how much gold investors should own?
I think your numbers are right in the sweet spot in terms of where we tend to see the allocations coming in. When we get to the larger pension funds or policy portfolios, you might start to see the number a little bit smaller because gold might be being added in as a particular component of a subset of the global portfolio that institution's managing. But the range we typically see for investors is between 2.5% to 10%. And simply put, that's where you start to see the best benefits when it comes to the risk-adjusted return impact on your portfolio. So it all depends on what an investor's desired outcome is, what they're holding, what their intended hold period is across all of those assets. And as I've mentioned, as they look at gold as a component and what its impact can be in terms of risk-adjusted returns, that 2.5 to 10% is the range that we often see. We spend time, as does State Street, with their clients, SSGA, spend a lot of time working with people to simply say, these are ranges, but let's talk about what you're looking to achieve, and let's get you down to a number that's helpful and most appropriate. Again, that's something, if you work through our website, you can get a flavor for what kind of impact gold could have by just adding it. And it's also an opportunity for us to help people out. That's where we do spend time talking with investors and clients, working with them to give them data and insights, and also, this information to work through their process of understanding what allocation is appropriate.
Great. So you mentioned 2.5 to 10%, depending on risk tolerance and other factors. Should that allocation include gold miners too, which are basically leverage plays on gold?
So it depends on what the investor is looking to achieve. So you made reference to the fact that it's a leverage play on gold. I'd simply say, in simpler terms, if your performance, if you're looking for the benefits of owning the precious metal outright, then you can look at gold in all of its forms, whether it be in gold-backed ETF or in physical form. And if you're more comfortable or looking to get exposure to gold mining companies, it's a different analysis. Clearly, gold plays into the decision to make an investment in a gold mining company, but you're looking at a company that has a management team and operating activities. So it's a different investment. And so what I'd say is, again, it goes back to what are your objectives and your goals. If you're looking for a safe haven asset that gives you the performance criteria of what the precious metal does, maybe gold is better for you. But if you're interested in making sure that you gain some of the benefits of a mining company that come along with gold plus, then maybe the mining company is a better pick for you. It's up to the individual client to choose. We would advocate understanding the gold market in general, and then as you start going down the path of what your objectives are, being wholesome in your decision and your analysis to figure out the best way for you to gain the exposure.
Again, very helpful and very interesting. That's all we have time for today. Joe, thanks again for joining us.
And thank you very much, Nina, for having me today.
Thanks for listening. If you want to learn more about gold and gold ETFs, please visit gold.org. Their website has really interesting data and commentary on the precious metal and precious metal and gold-backed ETFs. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.